Hello, St. John's alum. My name is John Ceparano, and I am a CPA and a certified financial planner. Today, I was asked to talk to you about how to gift smarter. Most people gift with their heart, but today I really want to talk about how to gift with your head, doing things a little bit smarter. The two areas I really want to talk about that are critical for gifting are qualified charitable distributions, which are basically distributions from your IRAs that go to qualified charities, and also the use of a donor advised fund, which are usually for larger gifts. A QCD is basically just a distribution out of your IRA to get a tax benefit. If you're charitably inclined, you can write a check, but if you want to ensure that you have a tax benefit, there are certain rules that QCDs have. So first of all, you have to be at least 70 and a half years old to be able to make a qualified charitable distribution. You can't give more than $100,000 in distributions that are qualified charitable distributions away in a year. Most people can't do that, but there are rules. And the QCD needs to be made by 12/31 of the calendar year in order to qualify for that year that you made it in. And most importantly, QCDs can reduce your required minimum distribution, which starts at actually age 72. So the real benefit here is that you don't have to go through a lot of hoops. When we used to itemize and itemize deductions, the standard deduction was much lower for itemizing deductions. You're able to get charitable contributions, you get some benefits. You write checks, you give away clothing, whatever you do, combined with your mortgage when you were younger, your real estate taxes, and they had a lot of other things out there that you can deduct, and a lot of people were itemizing. Well, now that's almost eliminated most people because the standard deduction has been risen so high that in order to get the benefit of any kind of charitable contribution, it has to be significant. And that will play in when we talk about donor advised funds in a few minutes. But for QCDs, to satisfy your required minimum distribution, you need to, and you're charitably inclined, you need to make those charitable distributions come right out of your IRA and go directly to those charitable organizations. You cannot take the money out of your IRA and then write a check to them. You will not get the reduction in your taxes. So they eliminate the thresholds that you have to get over for itemizing deductions. On top of that, the IRS has taken away some of the previous deductions that they allowed. In 2021, on the front page of your tax return, as an adjustment to your income, you're able to, without itemizing, write off $300 if you're single or $600 if you're married joint. Now that is gone. They also reduced the amount that you could deduct on your tax return from 100% of your adjusted gross income. You could write off charitable deductions back down to 60, which is what it was previously. So the qualified charitable distributions become very favorable. So let's just make believe that you had a required minimum distribution. You turned 72, and that required minimum distribution was $50,000. If you were charitably inclined and wanted to give away $20,000, you would take it directly out of your IRA and have it sent directly to that charity. That will reduce your required minimum distribution, a taxable portion, by that 20. So instead of getting taxed on the full 50, you'd only get taxed on the 30, which is the remaining balance that had to come out. That could be very significant if you're even in the 12% bracket, that's $2,400. You double that, it's $48. You get up into the 30% bracket plus, the numbers are huge in terms of tax savings. And most people would rather not make the IRS the benefactor of that, like a charity, and instead get that money to the charity themselves, the full amount of it. So there's many reasons to really consider using QCDs. So what other benefits are there? When it comes to QCDs, when you lower your taxable income, you're lowering your adjusted gross income. And adjusted gross income is utilized by the IRS to determine what levels of tax other things get taxed at, such as your Social Security, such as your Medicare premiums, and the net investment income tax that came up a couple of years ago, which is an extra 3.8% on your basically your passive income, your interest, your dividends, your capital gains. So when you're lowering your adjusted gross income by your QCD amount, that could dramatically impact your other sources of taxable income, therefore lowering your taxes even more. So using qualified charitable distributions is a very sound and prudent way to gift. So if you want to give more significant amounts of money away, I might recommend a donor advised fund. So donor advised funds are meant for substantial amounts of gifts. Just let's say at least $25,000 or more, typically, is what I've seen. And what people will do is we'll say, what is your charitable intent for the next 2 years, 3 years, 4 years, 5 years, whatever it is. And if they say, I want to give away $10,000 a year, they can make in one particular year $50,000 into a donor advised fund and get a tax benefit for that. They won't get it for the standard deduction amount that you'd get anyway, but if you combine that with your real estate taxes, and let's say that those are $8,000 or $10,000, maybe the first 10 don't count, but that's the whole point. Because if you did it $10,000 a year plus your real estate taxes as a person in the 70s with no mortgage, you'd get no additional tax benefit. But if you lump it together in 1 year, it can dramatically reduce your taxes. Now, here's the good part too. You have total flexibility with a donor advised fund. You can put the money into the fund, but you don't have to give it all out in 1 year. There isn't even a rule on when you have to give it out. So you can spread it out over a number of years. And then you can refill that bucket again at any time or add more to get more tax deductions, especially in a income windfall year where you want to offset it, such as when you sell a business, sell a major stock or mutual fund, or retire and get a lump sum distribution that was your only option, let's say, which is not always your option. But if it was your choice, these donor advised fund contributions, if they're significant, can make a dramatic difference on your taxes. We are going to have a Meet the Experts session coming up on October 18th. I hope that you can attend. It'll be live at the Garden City Hotel on Long Island. And I look forward to answering any of your questions. We'll be going much more in advance on these subject areas and other ways to gift, as well as other ways to save on taxes and financial planning. I hope that you have a great rest of the summer. But if you need to contact me in the meantime or have any questions about qualified charitable distributions or donor advised funds, please just shoot me an email at JOHNC, that's John C, at MODERAwealth.com. I look forward to seeing you soon. Enjoy the rest of the summer. Take care.